Hello, and welcome to the Invest with Carl podcast. I'm your host, Jamie Eppenberg, and a member of the Carl team. Today, we are back again with Victory Peak and David Bush, the strategy manager from Victory Peak, which I think was our third strategy on the platform. So it's actually been running for a little while. So we'll talk to David about 2021 and 2022 and see how we're doing. David comes to us from Alphatative that manages the Straversify Enhanced Quantitative Hedge Fund strategy that Victory Peak was originally based on. David has been self-employed for over 35 years, and years ago, as a professional musician, he worked with Grammy award-winning and nominated artists. And he also, during that time, sharpened his investment savvy, becoming both an independent trader and an investments educator in the US and the UK. Over that time, obviously, he continued to work in investments, and today he focuses on the management of Victory Peak out of the greater Cincinnati area. Welcome to the show, David.
Thank you, Jamie. Great to be here, as always. Happy 2022.
To you too. Yeah. So before we get started, we're going to talk about 2021 and 2022. But before we go into 2021, remind our investors, what is Victory Peak all about?
Sure. Victory Peak is a long-short equity strategy. It is U.S. equity, so domestic equity from where I sit. It is a largely mean reversion strategy, although it does have a volatility component designed to capture periods of excessive volatility in equity markets, which, as we all know, they do experience from time to time. In a nutshell, that's it. Our holding period is days to a few weeks typically. So our probability focus is in the relatively near term, which makes, in our view, the strategy pretty nimble to navigate, changing equity environments.
Right. Victory Peak, and the regimes, I remember now. So with bring us up to speed on 2021. How did Victory Peak fare in 2021, and what kind of market were we dealing with?
Well, I'll leave the second question for a moment because a fascinating one among many other things. So in terms of 2021, Victory Peak, performance, et cetera, it was our, obviously preceding Carl, we've built a track record for a while. It was our 11th year since strategy inception. It was our 11th year of positive returns, continuing, the no losing years in our track record. And, this is in line with our internal mandate of absolute return. So that's something we obviously always strive for. In terms of the performance of 2021, it was a below average year for our model, but it was in line with our model, which I can certainly elaborate on if you like.
Yeah, of course.
In terms of how we wrapped up 2021, finished very strong. Fourth quarter was, nicely positive, and we were up, every month in that fourth quarter, despite the S&P 500 total return being down in November.
Great. So obviously still a good year for Victory Peak and meeting the expectations that you have for the strategy itself, it sounds like. What kind of markets were you dealing with, and how did the strategy fare throughout the quarters?
Sure. The market was obviously a fascinating one because we're dealing with a somewhat anomalous time. Valuations are high, which I'll kind of save perhaps for outlook on 2022. But in terms of the technical action of the market, very impulsive to the upside. You had value stocks taking the lead earlier in the year, growth stocks zooming back as Omicron surfaced towards the end of the year. So it's a very nuanced year. And of course, you had other fascinating, relatively new, I would argue, events such as the meme stocks, so-called meme stock phenomena,
Yep.
and so on. So it's a very interesting year, just from a purely looking at the market analyst kind of perspective. I can elaborate on that, but that's the year we just went through. In terms of where we are in this market, that is, and I say where we are in this market, what chapter we're in of the bull market, which has been running from the Great Recession, post-Great Recession to this very moment. That's I have a lot more to say on that, which we can get into.
Yeah, I'm sure our listeners are interested in hearing more about that. I did want to take, before we leave 2021 though, what did you think about the retail investors and their impact? And I've been talking to several of the strategies, and it has been an interesting phenomenon and one everyone is watching. Like, how much of an impact did that have on the market this year, do you think?
I think over the last, from the lows of the 2020 drawdown, which was fierce and dramatic, and happily for our strategy, our best month in our 11-year track record, or 10-year at that point. Since that period, combined with the stimulus, et cetera, it's been a huge influence, the retail investor. So, and then you can drill down to specific areas, the meme stocks, and driving, stocks with, somewhat ordinary, stocks, unremarkable companies in many respects.
Driven by tweets, maybe that was.
Yeah, exactly. Driven to phenomenal heights, and really wrinkly noses of a lot of hedge funds who have outside positions on the short side, and some of those names at the time. That's a whole discussion in and of itself. So it's been very influential. I find I would say I'm not one of those managers who would put my nose up in the air. I mean, this is, you can look at the retail investor and that involvement as maybe a sign of excess, in a aging bull market. So that's a separate discussion. But just in terms of activity, there's micro share investing now. So the barrier to entry to get into the stock market for a young new investor / trader, it's the lowest it's ever been. Commission-free trading at many places, et cetera. So, I mean, I think that's a great thing. Others would argue differently, I'm sure, but it certainly was an influence, to your point, in 2021.
Yeah. It's kind of what everybody's talking about, but I think, we've mostly talked about it's here to stay, right, for a while. But those retail investors may change over time. Whether or not they're going to behave the same way year after year, this is just the beginning.
I would, and if I could add to that, I think that the on-ramps that now exist for newer investors / traders, retail folk, those are here to stay. I agree with you. As I mentioned, the micro share investing, sub one share purchases is very important when you have, $100 share prices, right. Which is not, that was not common when I started.
Right.
Splits were more common. Many other things were different, of course. But I think those on-ramps from commission-free trading, brokerages like Robinhood, which are disruptors, and other factors, you're right. It's here to stay, even if the enthusiasm, the volume, et cetera, changes due to market in its cycle. I think that will see shifts in that retail involvement, but the on-ramps will remain.
Yeah. I mean, honestly, Carl, too, we're looking to make, similar changes in the hedge fund industry, right? That we're going to get right. investors who aren't investing multi-millions, right? Right. Which is why most of our strategy managers have a similar perspective to you, that it's not a bad thing. We just all have to learn to take in the new data. I will note that none of our hedge funds take the positions of the hedge funds that got hit in those new realities this year. At least we don't have any to date that take those kinds of positions. But setting 2021 aside, what what are you looking at in 2022? What are you looking at for the strategy? And I just want to be clear with all of our listeners that these are just personal opinions. We are not making any definitive notions of the market and what will happen, but giving perspective for from our own personal positions.
Agreed. Where I sit as to 2022 is that, as I alluded to already, we are in a aging bull market. On the one hand, stocks have outpaced inflation historically. They have often done well in more inflationary times. So there's an argument that's quite bullish for stocks to remain bullish, et cetera. I wouldn't discount that. On the other hand, we are in a bull market that's quite advanced in my view. And when you look at valuations, which really aren't part of Victory Peak so much, Victory Peak is very technically driven, technical factors, and I could elaborate on that. But if you just look at valuations, the recent 10-year CAPE ratio, just a valuation ratio, is at, I believe, the second highest level it's ever been outside of the internet bubble. So valuations for U.S. equities are high. That doesn't mean that the market can't go higher, but what it has meant in the past is that looking forward, equity returns, the expectation for them should be lower than, let's say, when there's a low CAPE ratio and PEs are lower and so on. So does that mean, for listeners out there, avoid stocks? Of course, I'm a long short equity manager. I say no. But the reason I especially say that, I think the real, perhaps it's a bit self-serving, but I think the real message, or my takeaway anyways, is, this is a time, if you're concerned about future equity returns, to seek active management. We're in a cycle where passive management and indexing and that whole approach, and I could say some positive things about it for certain investors, but we're at a point where that is it's the gospel, and people tend to forget. And I've probably said this on a past podcast with you, perhaps, that we're also in a period where people are in love with the stock market, and that's not a sentiment that is constant. There will be a period where people will perhaps really revile stocks, at least for a period of time, and that creates all sorts of value investor opportunities. But to, I guess, kind of summarize it, valuations are high, and this is a time where I would say there is greater risk for your average investor. A great time, in my view, to be with an active manager who is minding the store, and not just purely passively invested in beta or just market same returns.
Right, totally hear you. I've brought up with other managers that if I had been betting, I thought fourth quarter of 2021, there would have to be a larger dip than there was. And it didn't happen. But I think most investors are looking at what you are, which is why, this has been a while, right? This has been going on a while, and there's the anticipation of a shift is just building and building. So what does this mean for Victory Peak? How is it poised? You talked about active management. Obviously, This is actively managed, as all our funds are. And what do you think? Do you care what the market does this year? What's best?
That's a great question. The answer to that question, I would say, is largely agnostic to, or a simple no to that question, but we try to be agnostic to, to market direction, or having a prediction for equities in any given year. We may have our opinions, but what's most important is what the data is telling the strategy logic, which obviously drives our activity. So In some sense, I could say, no, I don't really care what the market does this year. I care what the strategy does, which is navigate environments. So that is, I think, one of the toughest, jobs as a manager is to navigate different regimes, different markets, changing environments, especially within equities. And so that's our obsession. That's my obsession as the person who created the strategy, is to make sure that the systems within the strategy are continuing to perform, looking for, what we call edge decay. Is there a system that is not performing? And is that normal? Does something need to be worked on? So that is really always our focus, whatever the year, whatever the environment.
Yeah, excellent points. I think I heard you mostly that the strategy works. It works to be prepared, and so you're not necessarily betting on any particular market. It's just that is the strategy prepared for whatever the market brings this time around.
That's right. The strategy aims to navigate different environments. So there are, if I could digress for a moment into kind of the logic of the strategy, there's a bottom-up process that's looking at every name in our universe, which is NASDAQ 100 and S&P 100. So blue chip, mega cap equities. There's a bottom-up process that's looking every day at that whole universe and looking to determine on a name-by-name basis, stock-by-stock basis, what regime is that stock currently in? And then the logic will dictate whether there's an opportunity there, and the probabilities differ between regimes. So that's the bottom-up process. The top-down process is also, of course, quantitative entirely, and it looks at, is there volatility, acceleration? That can have a very broad effect, of course, on all those names in the universe. So we look for acceleration in the volatility index. We also look at the market state. We've looked at different strata of when the market's making new highs, for example, which is not happening as we speak, but has been happening for some time, throughout last year, for example. And we've looked at how the strategy performs at different levels of extension of the market above various averages, means, et cetera. And so that's a factor that actually we've determined as a broad market risk factor. So that's, again, the top-down process. And so obviously that's a very high-level recap of what's going on in our strategy. But that between those two processes, which work together under a set of risk controls, that's how we try to navigate environments. And as you kind of already put, we don't have a positioning for 2022 based on some macro bullet points. We have data that we are, that our logic, of course, is consuming every day, and that determines how we're positioned, our exposures, and so on.
Right. And being a long short, I guess, unlike being in a mutual fund or some other, a non-hedge fund investment vehicle, as you take a look at much more data than a human being can process, right? You take the positions that, according to the strategy, have the highest probability of happening based on the data that it's consuming and reviewing.
Correct. Yeah. That is always the strategy's objective is to in its hierarchy of logic, which I'll spare you at the moment, but to do exactly what you said.
Right. So I just want to point out to the listeners that means that you really attempt to perform in any market, right? That's the goal. And I just want to also remembering Victory Peak, and this is going to pull through 2022 as well, but you have a lot of, it's a risk-based, you have a risk-based approach. So there's also, compared to indexes, you're trying to make sure you're risking less of a client's funds, right? In order to get a similar return, right? That's one of the, I don't know if you call it a tenet, but one of the goals of the strategy.
Yeah, I think that's well said. We try to have equity market-like returns. That is our objective with less risk. So less heartache, if you will, along the road. And active management means that the strategy is looking for periods that could become worse periods, et cetera, and trying to protect. So historically, it varies naturally, but historically, we have a lower annualized volatility, to get technical, than the equity market, the S&P 500 total return. And in similar returns since inception, although various periods, of course, will fluctuate as you can expect.
Yeah. We've talked about those before too. I probably should do another podcast on those sometime soon. But to look at a strategy, it's important to look at not just their gains, but how they're protecting the money as well. And it sounds like Victory Peak, we'll see how it goes, poised for whatever the year may bring. And I guess we'll see if we're going to bull market through another 12 months or if we're going to have a major dip. David, thanks so much for chatting with us today. Really good to see you again.
Oh, pleasure. Thank you, Jamie. Anytime.
And thank you to our listeners. Hope you enjoyed this episode, and we will see you next time. Bye-bye now.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.